Hi everyone, thanks for joining us today. We're here to talk about a lesser known retirement savings vehicle, better known as after-tax or backdoor Roth. I'm Greg Fiore, Retirement Plan Advisor and Managing Partner at Clearview Advisory. Today we'll explore how after-tax works and why it can help maximize your retirement savings. The most common option is contributing to your 401k on a pre-tax basis. The money you contribute goes in before federal and state taxes and grows tax-free. The same is true for employer contribution. Pre-tax is the most common way to invest in a plan. It should be noted, employer contributions are always contributed pre-tax. When you make Roth contributions, you pay taxes now and avoid paying taxes on withdrawals. In addition, you avoid paying taxes on the growth. This option is great for people who have a longer time to save and those who expect to be in a higher tax bracket at retirement. You also have a third and less common way to save in your company's retirement plan called after-tax contributions. After-tax should not be confused with Roth. These are two different buckets of money. With after-tax, you pay taxes up front and the money grows tax-deferred. The money looks and acts like traditional savings or a brokerage account. However, you don't pay tax on the interest until withdrawal. We get one common question when discussing after-tax. Why should I contribute to after-tax instead of saving outside the retirement plan? At the end of this presentation, we will answer that question and where after-tax fits into your retirement savings strategy. Let's review tip number 1, where we discuss retirement plan limits and how to use the after-tax bucket for future retirement savings. The retirement and financial services industry promotes a 15% savings rate throughout your working years to be on track for retirement. It's one standard for everyone, regardless of income. In our view, this one-size-fits-all rate isn't accurate. The reality is your savings rate is dictated by the amount of your overall compensation. This graph shows the projections of where your income comes from in retirement by annual compensation. Generally, you can see that your responsibility for retirement savings grows the more money you make. While taxes and reduced expenses remain somewhat similar for all incomes, the percentage that Social Security will cover varies greatly. In summary, the more you earn, the less that Social Security will replace your pre-retirement income and the more your responsibility grows. Knowing you need to save more, what can you do? Let's review what the IRS allows. Each year, the IRS sets an overall limit. Within this overall limit, there are 3 other limits. Before we cover the additional limits, please make a note of the overall limit, which differs by age. The first IRS limit applies to your deferral of traditional employee pre-tax and/or Roth contributions. This is the most common limit when we think about retirement plan savings. The second limit is for catch-up contributions. Catch-up is allowed for those employees who turn 50 or older in any given year. This allows for older employees to save a little bit more as they get closer to retirement. The third limit is the amount remaining between the overall limit and how much the employee has saved. And this remaining limit can be a combination of employer contributions and/or after-tax contributions. Let's walk through an example. Amy contributes the maximum allowed by the IRS, and she receives a 3% match from her employer. She would like to save more, but what can she do? If she contributes after-tax contributions into the retirement plan, she can save a lot more and reach the full amount allowed by the IRS, which is the overall limit. So besides the ease of payroll deductions, why would she want to save additional after-tax money instead of saving outside the retirement plan? Let's look to tip 2 to answer that question. Here's how it works. You make after-tax contributions and convert those after-tax monies to Roth at any time, but ideally before your investment earnings accrue. Once your money converts to Roth, your growth is tax-free. When you retire and are ready to take money out, your distributions are tax-free like other Roth savings. All your earnings will grow tax-free, unlike traditional savings and brokerage accounts. This feature makes the after-tax savings a more powerful tool than regular savings. Secondly, and keep in mind, this is an additional Roth savings on top of the amount already contributed and allowed by the IRS. You are not foregoing that pre-tax savings by contributing to the after-tax bucket. We went over a lot of information today, and things can get complicated. The good news is you can reach out to us at Clearview Advisory if you have any questions. Thank you for joining us to talk about savings for retirement.